Stocks Safe Haven Assets Ratio Indicator explained. What is this indicator? It takes an index like the NASDAQ or the New York Stock Exchange divided by a safe haven asset, U.S. Treasuries, bonds, corporate bonds, gold. It comes with a number. If the stocks is the top number, the higher the number, the more greed there is. If the number is a low number, a negative number, then there is very fearful. We are top-down approach to investing, which focuses on the big picture or how the overall market is trending. Then it will look at the performance of the sectors, industries, and ultimately stock prices. If the sector is doing well, chances are the stocks in those industries will also do well. Stocks and safe haven assets can help you both with the macro picture, the sector picture, and the individual stock pictures. So let's go again. The ratio. It's taking an index. Which index you want to take is up to you. But let's just say we're taking the New York Stock Exchange Index. Then it combines it with safe haven or divides by safe haven assets. These safe haven assets could be U.S. Treasuries, corporate bonds, precious metals, stocks from a particular sector like consumer goods. It really depends on which way you're looking at things, or maybe even defensive stocks, currencies. What it explains, it will explain to you if there is fear, greed, extreme fear, extreme greed, or neutrality. It's usually the opposite direction. So if everyone is buying into stocks, the number is very high and it is showing a top. I have seen, especially at extreme levels, this ratio has worked very well. I use it specifically to help me understand the macro issue and when stock bear markets or bull markets end, because these ratios are usually at a very high extreme level. Of course, we use a weight of evidence. We don't just use one indicator, but this is one of the indicators that will tell us when this 2022 bear market will end and the bull market starts, just like it did in 2020 for the COVID days. Let's go further. The CNN index also has this indicator, and they call it the safe haven demand. How do they use it? Stocks are riskier than bonds, but the reward for investing in stocks over the long term is greater, supposedly, and usually. Still, bonds can outperform stocks over a short period of time. Safe haven demand shows the difference between Treasury bond and stock returns of the past 20 trading days. Bonds do better when investors are scared. The Fear and Greed Index uses increasing safe haven demand as a signal for fear. This interpretation of this ratio is done by CNN, and they take a 20-day difference between the stock and the bond prices to give you fear, an indicator. Let's look at one of their charts. As you see, it has when stocks are outperforming bonds, the number will be higher, and when stocks are underperforming bonds, the number will be lower. The lower numbers in April helped us time to change the market and go long the market. As again, in the April time when the number was at 15, it gave us a helpful indication of when to short the market or get into cash. This indicator is very useful, and you can take any of these ratios and track it on a 20-day moving period. We follow this ratio, the CNN, every day, and our own ratios on a weekly basis. Specifically want to take a look at the Safe Haven Demand Index in March 2020, when their number was at extreme fear of minus 25%, and it has never seen that. So again, this indicator calculates the difference between returns for stock versus returns for treasuries. Over the last 20 trading days, bonds have outperformed stocks by 30.4% points. This is close to the weakest performance for stocks relative to bonds in the last 2 years for 2020, which it indicates people are fleeing stocks and going for the safety of bonds. It went from fear to extreme. So, by just tracking this one indicator, it will give you a very indication on when new bull markets are starting and when new bear markets are starting. A safe haven. A safe haven is a type of investment that is expected to retain or increase value during times of market turbulence. Investors seek out safe haven in order to limit their exposure to losses in the event of market downturns. However, what assets are actually deemed safe havens can vary depending on the specific nature of the down market. That means in order for an investment to act as a safe haven, investors must perform ample due diligence. Understanding safe havens. To this ratio to work, you need to understand which are the safe havens. Which are the safe havens that work for you best in your trading system. A safe haven investment diversifies an investor's portfolio and is beneficial in times of market volatility. Most times when market rises or falls, it is for a short period of time. However, there are times such as during an economic recession when the downturn of the market is prolonged. When the market is in turmoil, the market value of most investments falls steeply. While such systematic events in the market are unavoidable, some investors look to buy safe haven assets that are uncoordinated or negatively correlate to the general market during the times of distress. While most assets are falling in value, safe havens either retain or increase their value. Key takeaways. Safe haven investments offer protection from market downswings. Precious metals, currency, and stocks from particular sectors have been identified as safe havens in the past. Safe havens in one period of market volatility may react differently in another, so there is no consistent safe haven other than portfolio diversity. Examples of safe havens. There are a number of investment securities that are considered to be safe havens. Gold. For years, gold has been considered a store of value. As a physical commodity, it cannot be printed like money, and its value is not impacted by interest rates decisions made by government. Because gold has historically maintained its value over time, it serves as a form of insurance against adverse economic events. When an adverse event occurs that lingers for a while, investors tend to pile their funds into gold, which drives up the price due to increased demand. Treasury bills. These debit securities are backed by a full faith and credit of the U.S. government and hence are considered safe havens even in tumultuous economic climates. T-bills are considered to be risk-free as any principal invested is repaid by the government when the bill matures. Investors therefore tend to run to these securities during times of perceived economic chaos. Defensive stocks. Examples of defensive stocks include utility, healthcare, biotechnology, and consumer good companies. Regardless of the state of the market, consumers are still going to purchase food, health products, and basic home supplies. Therefore, companies operating in the defensive sector will typically retain their values during times of uncertainty as investors increase their demand for these shares. Cash. Arguably, cash is considered the only true safe haven during periods of market downturn. However, cash offers no real return or yield and is negatively impacted by inflation. Currencies. Some currencies are considered safe havens compared to others. In volatile markets, investors and currency traders may seek to convert holdings of cash into these currencies for protection. Considerations. The assets listed above are not guaranteed to maintain their values during periods of market volatility. Furthermore, what constitutes a safe haven changes over time. For example, if an entire economic sector is performing poorly, but one company within that sector is performing well, its stock could be considered a safe haven. Investors should carry out due diligence when looking into invest safe havens, because an asset is considered a safe haven in a downturn may not necessarily be good investments or good for the ratio when the stock markets are rising. I like this indicator. This is not a day trading indicator. This could maybe not even be an intermediate term indicator, but it is a very good long-term indicator. This can tell you when the inevitable bear market is over with and it can also tell you when a new bull market is starting. Looking at the extreme levels can be very helpful. Now, what you use for stocks, I think is pretty easy. New York Stock Exchange, NASDAQ, the percentage it is up on a weekly basis, daily basis, tracked on a 20-day or 10-day or 30-day moving average, works very well. What you use for the bottom area, that could be a little bit more. Some people use U.S. Treasury. Some people use junk bonds. Some people use even consumer goods or something they have to eat. Also, of course, bonds and the United States Treasuries. I like this indicator. I use this indicator. So I believe you should put this into your trading system. If you know the direction of the macro, it will become very easy to tell you which sectors are coming up and which stocks to go for. If we are in a bull market, it's a lot easier picking stocks. If we are in a bear market, it's a lot easier to short it. So for this ratio, you know the catchphrase. Study it, analyze it, adapt it. Peace.